In this presentation, we will discuss the mechanics behind discounted cash flow models. At the end of this series of presentations, we will value a company using a free cash flow model. To do this, we will forecast financial statements for the company for each year over a future period. We will then use those forecast financial statements to calculate estimates of free cash flow for each year over the horizon. We will then discount back these estimates of free cash flow to arrive at a value for the firm. Before we do this, we must understand what we're doing. We must understand the process and the underlying logic behind discounted cash flow models. I will explain the mechanics behind discounted cash flow models using the dividend discount model. The dividend discount model is a particular type of discounted cash flow model. Consider the value of a bond. The value of a bond is equal to the present value of the future coupon payments that the bondholder will receive, plus the present value of the final face value that the bondholder receives on redemption. We can also think of the value of a share in a similar way, but instead of coupon payments, the company pays dividends, and instead of a face value redemption, an investor can sell and receive the share price at some future date. Shares have an intrinsic value. The intrinsic value is the present value of the future payoffs anticipated by an investor in that share. You can think of the intrinsic value as the share's fair value. If an investor buys a share at its intrinsic value, their expected rate of return will precisely equal the discount rate. The return on investment will just compensate the investor for the opportunity cost of their money. Let's consider an investor who plans to purchase a share and hold it for 1 year before selling it on. Let's assume the investor will collect the first year's dividend and immediately afterwards sell the share on. The expected return for this investor is equal to the dividend that they expect at the end of the first year, plus the change in the share price over that year, divided by the initial investment amount, or the price that they pay at the beginning of the investment period at time t equals 0. We can rearrange this equation and we can explain expected return as being equal to the dividend expected at the end of the first year divided by the initial investment amount plus the change in the share price over that year divided by the initial investment amount. In other words, the expected return is equal to the dividend yield plus the capital appreciation on the share. Bear in mind the actual return may end up being different from the expected return. It may be more or less. Never confuse the actual outcome with the expected or anticipated outcome from the perspective of investors. In a competitive market, no price but the intrinsic value of a firm can survive for a long period of time. This is due, in theory, to a self-correcting mechanism. Let's discuss this mechanism. If the current price of a share is greater than its intrinsic value, this will result in a reduced expected return for that share compared to other securities with similar risk profiles. If we consider the equation we just discussed, if the current price, or the share price at the beginning of the investment period, P0, is higher than the intrinsic value of the firm, this will mean the denominator in this equation is high. Because the denominator is high, the dividend yield and the capital appreciation components will be low, and the overall expected return on the share will be low compared to other securities with similar risk profiles. But what should happen if investors are rational is they should sell the security with a lower expected return, and they should acquire the other securities with higher expected returns and similar risk profiles. The selling off of the shares of this company will cause its share price, or P0, to decline. As the denominator in this equation declines, the overall dividend yield and capital appreciation for the share will increase, and the overall expected return on the share will increase. And so In a competitive market, no price but the intrinsic value of the firm, in theory, should survive for long periods of time. In a well-functioning market, all equally risky securities should be priced to offer the same expected rate of return. At the end of this series of presentations, we will engage in fundamental analysis. Fundamental analysis involves investors attempting to find mispriced securities by analyzing fundamental information such as accounting data and business prospects. Fundamental analysts use net present value and measures of cash flow to do this. Bear in mind, this assumes that markets are inefficient to a certain extent, and the prices of shares differ from their intrinsic values. If the market was strong form efficient, the market price of the share would be the best estimate of its value, and there would be no point to undertaking a fundamental analysis other than to justify the price. So by building discounted cash flow models, we are assuming that the market is at best semi-strong form efficient, and that it is possible for the market prices of securities to differ from their intrinsic values. The point of fundamental analysis is to try and come up with an estimate of the intrinsic value of firms to compare to their current market prices.